Hello, everyone. This is Joe Zappia from LVW Advisors, and I'm here with Lori Van Duzen, CEO, founder, and co-CIO of LVW. And we're delighted to present our State of the Markets first quarter 2023. Hello, Lori.
Hi, Joe.
Thanks for doing this. This should be a great conversation. There's so much to talk about. But before we get too far in, I'd just like to go through some of the legal and compliance stuff. And none of what we talk about today or any of the information on the slide should be viewed as a recommendation by LVW. And clients of LVW may or may not hold any securities that are mentioned during today's webinar. With that said, let's get started.
Thanks, Joe.
So I think that we would be remiss to talk about anything related to 2022 without talking about inflation, because inflation really was the story of the year last year. The slides that's up shows what really happened to CPI through the course of 2022. And one of the things that you and I were talking about earlier, Lori, was that a year ago today, which today is February 21st, the Fed had not even started raising interest rates yet. In fact, I think that Fed Chair Powell had said that they anticipated that they would do two 25 basis point increases in calendar year 2022. And fast forward a year later, they've made 18 25 basis point increases. So inflation really was the surprise.
Yeah, it's remarkable the amount of interest rate hikes we've had in such a short period of time. Most of us have not lived through this kind of cycle, even those of us who have done this for a really long time. And inflation is all of the focus. It's still the focus. But if you take a look at this chart and into January of 23, it's interesting, right? So that blue, solid, dark blue bar, part of the bar, shelter, persistently high, that's rents, housing. But if you look at other things, you're starting to see inflation declining or rolling over. And if you look at what's happening, it's not on this chart, but I could speak to just the commodity markets. If you look at Baltic Dry, the index, Baltic Dry index from the high down 90%, lumber down 77%, natural gas down 75%, base metals down 28%, and it goes on and on. So what's interesting, I guess, is that we are starting to see inflation come back, but clearly this is still the focus of the Fed. And the real question that is very difficult to answer is, when will the tightening or the interest rate hikes stop?
That's right. And it seems that the financial markets keep having these sort of fits, starts and stops in terms of expecting a Fed pivot, expecting the end of rate increases, but then economic data just continues to keep coming in hotter and hotter. So let's talk on the next slide. We show exactly the track of the Fed. So in March of 2022, 11 months ago, they raised interest rates for the first time, 25 basis points. And then from May until November, they got really aggressive and they raised interest rates a total of 3.5% between the period of May and November. That's the fastest and steepest increase in rates in history. And the Fed now is on track to get to about 5%, which is actually consistent with what they've been talking about. And the bond market is has really adjusted to those expectations. So what have these increases done to the economy? Because the intention really is to have these rate increases slow down the rate of growth in the economy. And as you said a second ago, we're really starting to see it in certain parts of the economy.
Yeah, could I just maybe jump into that slide? The
Sure.
2-year T-notes now at 466, and yesterday the yield on the 6-month Treasury did touch 5% for the first time since 2007. These are big moves, and these will and do have an impact on the economy and the markets. And it's really trying to figure out what is a leading indicator, what's a lagging indicator, and try to unpack all this data we're seeing, right?
Yeah, absolutely. And then the next slide just talks about liquidity conditions in the market, because as rates go up, at the same time, the Fed is also operating under quantitative tightening, and they're taking money as off the balance sheet as they do this each month by eliminating bond purchases and letting bonds mature. So you can see here that the dark line shows money supply in the United States, and you can see the huge spike because of COVID, really way above trend going all the way back to 2000. But now money supply growth has actually turned decidedly negative. And so liquidity is leaving the system. The Fed is raising rates. And I think, we know this, that a lot of these increases sometimes take 6, 12, 18 months, depending on the sector, depending on the industry, to work their way through the economy. So conditions are
Right.
tightening.
Yeah, and what that links to is a kind of credit cycle change or reversal. When you look at things today, like subprime auto loans, delinquent for 30 days or more, it rose to something like 9.3% at the end of 2022, the highest since the economy exited the financial crisis in 2010. So this is really, there are all these little indications, and some of them are bigger, that we have this kind of credit cycle reversal going on because liquidity has left the system. So
Yeah, absolutely.
okay.
Yep. So another indicator of what the Fed has done. This is the yield curve. So the graph on the bottom shows where the yield curve has ranged over the past 10 years. That's the gray shaded area. The gray line at the bottom is where the yield curve was December 31st of 21. And then fast forward to just last week, you can see that the yield curve is deeply inverted. And what that means is that the 3-month and 1 year and 2 year are now at a higher yield than that of longer term bonds. So the 10-year was at 3.86%. But at the same time, as you mentioned, the 1 year was trading basically at 5%. Inverted yield curves tend to indicate that credit conditions are very tight at the front end, and it usually is a precursor for a significant economic slowdown.
Usually and almost always. So, and this is the most, if you look at the 2-year and the 10-year, the inversion is something like 80 basis points as of today. And that is the most inverted curve since 1981.
Right. So that pretty important stuff.
Mm-hmm.
So all of this is interesting, but it also has to be thought of in the context of what financial markets do. And what we mean by that is that stocks and financial markets typically anticipate into the future as discount mechanisms, really better really than anything, especially things like the media and headlines. And so what this chart shows you is that when you look back over history, stocks typically bottom sometime in 6 to 9 months before the economy goes into recession, which is another way of saying earnings hit their low for the cycle.
Mm-hmm.
So
Right.
in October of 22, just a few months ago, the S&P was at one point, I think, down 28% peak to trough. We don't know yet if that's the bottom, right? But I think you and I both have a sense that it may be. And then if that's the case, then sometime between March and the end of this year, odds are pretty good that we'll have some negative earnings, and maybe even the National Bureau will declare an actual recession.
And maybe we'll retest that. We don't know. Maybe we'll retest that low. We really don't know. But what I think you're saying is waiting for the economy to bottom has historically been a mistake. If you look at 11 out of the last 12 recessions, the only outlier to that was the tech bubble. So it's really hard. It's very messy. The whole post-COVID exit, inflation, money printing, liquidity providing, reversal of that, it's very, very tough to, kind of navigate these markets. But there are certain kind of tried and true things that we know. And one is not to try to predict the bottom, but we might retest that October low.
That's right. We may. And we really won't know. A low is defined and confirmed only when the market makes another new high. So we won't really know
Right.
if October was the low until we actually make a new high. But we do know at that level we were much more constructive on U.S. equity than we are today after the market's gone up 15
Exactly.
or 18%.
and I know we're going to get to that, but those are the kinds of data points that we use to rebalance. So, we would be more constructive again if we were to reach that.
Absolutely. So let's talk a little bit about where markets are in terms of valuation. This chart goes back to 1998, and it just shows the average price to earnings multiple of the S&P 500 compared to itself over time. The 25-year average PE is around 16.8. One standard deviation above, which we would define as very expensive, would be a PE over 20. And one standard deviation below would be a PE of 13.5. And this is the history. So you can see today, all the way at the end of the chart, even in spite of a huge decline last year, the seventh worst year in the last 50 years for the S&P, the S&P is still somewhere between fair value and expensive. Would you agree?
I think that's true. It's all about interest rates and it's all about earnings, though. And I think that, you and I compare a lot of research and look at a lot of things. And I think that if we just focus on those two things, they're super important. If the Fed is really going to be, they have said consistently that they have this 2% inflation objective, right? And if they're really going to hold to that, and I'm not sure they are, and I'm not sure where inflation falls out, but that would involve a pretty big decline, I think, from here based on current PEs. If you look at history, and as a matter of fact, David Rosenberg wrote about it either today or yesterday. And he said if the Fed were to stick with that 2% inflation objective, their work would imply a level of the S&P 500 at something like 3,100. So that would be, over a 20% decline, which then speaks to that October low. So it's not, the market is not cheap. It's not super expensive.
Yeah. And I think for me, that's really the key takeaway. It's not obvious like it was in December of 18 or March of 2020 when markets were really dislocated and stocks were on sale. We're not in that place today.
We are in a very different monetary situation too.
Exactly. So. Okay. So let's just talk again. We'll spend just a second on this. This is just another way of talking about the US market. This chart's from Goldman Sachs, and look at all kinds of historical valuation metrics, including even comparing stocks to interest rates. And the conclusion here is if you look at the S&P 500 today in terms of expensive versus cheap, it's in the 85th percentile of expensive, 88th percentile of expensive relative to history. We don't really need to get into the details here, but the point is that using traditional valuation metrics, the same way business owners think about their businesses, stocks in the US, at least large cap, are still pretty expensive in spite of the big decline last year.
And then that leads into this, which are, equity market valuations in the US. And I'll say in the US look increasingly more expensive given real rates. But if we look at earnings, they're being revised downward. And we're seeing margins falling, and businesses that saw the largest rises in margins now are seeing the biggest fall. So things like freight, transport, car dealerships, things like that. But it's pretty decisively going not in the right direction.
Absolutely. In fact, earnings estimates are coming down at a rate that is at the greatest pace since the financial crisis. One thing I'd like to say here before we move on real quick is that this is what the Fed wants to have happen. They really are trying to slow the economy down through slowing earnings growth and having companies become less adamant about doing additional hiring, slowing down transactions, slowing down credit by having higher interest rates. So all this is playing out, and I'm reminded of the first webinar that we did was in March of 2020, or maybe April of 2020, in the middle of the COVID crisis, Lori, and you made a statement that I still repeat a lot today, and that is it's a huge mistake to bet against the balance sheet of the Federal Reserve of the United States. I'd say that is still true today, except it's in reverse.
Mm-hmm. Yeah, it is. It is. And, I think the next slide tells us that, equity investors should be used to declines, right? And we've had these kinds of declines that we've seen, regularly. And not to get too negative, it does sound kind of negative where we're going. I think what we're saying is that it's uncertain where interest rates and inflation are going to fall out. And so trying to predict this is nearly impossible. So we have to stick with disciplines, and our disciplines are around valuations, around earnings growth, and around liquidity conditions. And none of those are flashing green light, go. And so we're cautious. I think that's really what we're saying. But investors that have been with us a long time that would look at this chart are used to declines in equities. They're not used to seeing the declines we had in equities and bonds and other asset classes last year, right?
Absolutely, right. So this chart just shows, S&P average return and then maximum drawdown each year going back to 1980. Long story short is the S&P has been up 32 of the last 43 years, but on average it declined at least 14% on average at least once each year. So last year's decline, while uncomfortable, isn't really that atypical for stocks. What we really want to talk about though is bonds, because what happened in bonds last year has never happened before.
Right. I mean, these kinds of returns we have not seen, and this combination of returns for stocks and bonds being negative were really painful and not likely to be repeated in our opinion.
Yeah, and I think the chart on the left shows that the average return for bonds last year, investment grade bonds, was down almost 16%. So not only was this the worst year for bonds ever, it was the worst year by a factor of 2.5 times. The second worst year for investment grade bonds were down less than 6% in 1974. So anytime we see markets dislocate this much, we look for opportunity. And as you said a minute ago, discipline. So today we think fixed income or bond markets maybe offer much more attractive entry point. They definitely offer much more attractive entry points than a year ago, for sure. And this is where we're spending some time. I think you said in our last webinar, this year will be back to basics, keeping it simple.
Yeah, keeping it simple, back to basics. We may have seen almost peak yields here. I'm not going to predict it necessarily, but the Fed has clearly telegraphed what they're trying to do. So it probably makes sense to own bonds.
That's right. And for one of the first times in a long time, bonds didn't provide any form of diversification last year. So the 60-40 portfolio had its third worst year in history, and outside of the 37 crash and the Great Depression, it was the worst year ever for the 60-40 portfolio. If you think about it, the S&P was down 18, bonds are down 15-ish. So any combination of those two, you were down somewhere between 15 and 18%.
It was still a painful year. It was good to see that certain strategies were positive and all of that, but it was still painful. And this is what you just spoke to. It is a black swan event to see fixed income decline that much and stocks and bonds both negative. It's not something that investors are used to.
Yeah, so only 5 times, I'll just explain this chart real quickly. Going back to the Great Depression, only 5 times in history have both stocks and bonds declined in the same year. So pretty unusual.
Right. Very.
So just a quick summary of asset class returns. Just want to talk about one thing. One of the investment disciplines that Lori and I and our entire investment committee believe in is mean reversion, that eventually various asset class returns will revert back to their long-term average or their mean. And one thing I would say is that U.S. large cap stocks, as you can see up here in the upper right, the 10-year average return for the S&P 500, in spite of last year's 18% decline, is still 12.5% a year. And just as a reminder that the 50 or 70-year average returns for the S&P 500 are just a little bit less than 10%. So even after a bad year, stock returns are still above average. And then I know that you had mentioned that one of the things that jumped out to you on this slide was international markets.
Yeah, in our work on international developed markets, that when we look at these kinds of returns and then we look at valuations, valuations in the international developed markets are something like 2 standard deviations below the 20-year average. So it's, in our opinion, a buying opportunity. We've been talking about this internally. These markets priced in an extraordinarily large amount of bad news. And what's interesting in Europe, for example, is a lot of the inflation is energy related, and that's coming down rapidly. It's not labor related. It doesn't look the same as it does in the United States. So it's an interesting opportunity right now after a lot of years of underperformance relative to the US.
Right, absolutely. The other thing that really sticks out to me on this chart is bonds. So US bonds now we're down, aggregate bond index was down 13% last year, 3-year average return of minus 2.7, 0% for 5 years, and 1.1% a year for the last 10 years. So we're really approaching a lost decade for fixed income.
It's another kind of mean reversion thing though, Joe. You know, I wouldn't bet on bonds being bad this year. I'm not making a prediction. I'm just saying I wouldn't bet on it.
Okay, so speaking of that, speaking of that, let's just take a look at the changes. So I think this chart is really interesting, and these numbers have actually moved a lot even since we put together this chart. The 1 to 3 year aggregate index is currently yielding about 4.5%. Its 10-year average yield has been 1.4, and over the last 20 years, it's averaged 2%. So yields are more than double their 20-year average at the short maturity end of high quality bonds. Intermediate term bonds are over their average as well. And long-term bonds are actually, interestingly enough, still trading about at their 20-year average. So in our opinion, LVW's opinion, is the low-hanging fruit right now is at the shorter and intermediate term of the yield curve, where we're able to today get over 5% on a 1-year treasury.
Yeah, and it's probably obvious to say this, I don't know, but if we are entering a recession, obviously, you know, bonds do pretty well because interest rates are coming down. And if you look at 75 years of data, bonds outperform. I don't know, but would not bet against bonds this year.
Yeah, and the simple facts with investment grade bonds is about 95% of your return is determined by your starting yield. So if you buy a bond with a much higher yield today and hold it to maturity, you'll earn that yield, and that's much more attractive than it was a year ago. And I think that's really the key takeaway. So bonds, once again, can protect balanced portfolios and actually provide some attractive real income and more conservative portfolios.
Right.
So the other thing we talked about a little bit is U.S. versus non-U.S. And, you know, let's face it, the U.S. really has been the best place to invest for a long time. In fact, this chart shows you that now for 15 years, the U.S. has outperformed its non-U.S. counterparts in the form of stock market returns. Not only is this, it's one of the longest runs for the U.S. to outperform. And, you know, that may or may not be shifting now, but as you said, when you go as long as you have with these markets underperforming, valuations have slowly been compressing, right? In international markets.
Yes, they have. And I did speak to the 20-year average and 2 standard deviations below, but I think the next slide is the 10-year. And you can see this if you look at the developed Europe, where valuations are now versus the median. Pretty attractive if you're a long-term investor.
Absolutely.
I guess that's the most major takeaway from there.
Absolutely. So let's so maybe just you want to just sort of wrap it up with some of our final thoughts.
Well, sure. You know, I think what we're saying is that we're cautious based on U.S. valuations, but there are opportunities outside of the U.S. Over the short term. It's anybody's guess where interest rates fall out and what earnings look like. Earnings are decelerating. There are signs that the economy is slowing down tremendously in certain areas. There are a lot of mixed signals, though. I think the Fed's trying to navigate all this, and we don't want to fight the Fed. So we would take these higher interest rates and add fixed income and cash, which we have been doing in our portfolios. Simple, straightforward, high quality. We do dollar cost average, like in October, we would be dollar cost averaging if we retested that low or broke through it. We have been last year actively tax loss harvesting, as most of you know. And I think there are other opportunities outside of stocks and bonds that most of you that are qualified investors know that we invest in, which are things like a sleeve of alternative strategies that can make money when markets decline or have certain relative value or arbitrage strategies. We also are investors in, for some of you, in strategies around some of the dislocations we're seeing in liquidity. And so we're already starting to see companies kind of preemptively engage in discussions with some of our managers who are providers of liquidity because they see this, these liquidity concerns and restructuring needs. So we could spend a whole webinar on this, but there are things outside of stocks and bonds that are representative in our portfolio. And of course, we believe in stock picking, and the way we express that is in long, short kinds of funds in our portfolios, and also in high quality cash flow producing, dividend yielding equities, which I know you can speak to, Joe. I tried to do that really quickly to stay in our time limit. I hope that made sense.
Yeah, absolutely. I think I would just add to that by saying that we remain pretty cautious in the expensive areas of the market, like U.S. large cap growth, which outperformed pretty much everything else for the better part of a decade. We're focusing on companies that have durable competitive advantage and share that advantage through free cash flow and dividends. In fixed income and credit, Lori summed it up. We're really focusing on short-term, high-quality fixed income to clip those coupons. And I'd just say the last thing is right now we sit with probably a little bit more cash in our portfolios than we've had in a long time. That gives us optionality. And the nice thing about it is cash right now is yielding 4.5%, maybe even as high as 5% for tax equivalent investors that are investing in municipal bond money markets. So it's going to be a better year for investors, I believe, primarily because the fixed income part of the portfolio is actually paying us today, and that should help provide some diversification in portfolios.
Agree.
Yeah, so thank you. Thanks, everyone. Feel free to reach out to us if you'd like a copy of this deck or you'd like to talk about any of the slides that we talked about. We hope you found this enjoyable, and we'd love to hear your feedback. Lori, thank you.
Thank you, Joe. Very much appreciated. And yes, we welcome your feedback and questions.